Hello and welcome to RCLCO's May monthly economic update. I'm Scott Bommarito here to bring you a couple of the latest developments from the US economy over the last month. Inflation continues to dominate the economic news cycle, with the ongoing war in Iran pushing up energy prices, which have now rippled through to consumer prices more broadly. So the annual headline inflation, CPI inflation, accelerated to 3.8%. And as this bar chart on the left shows, a large portion of that was due to that gray bar from energy prices, which were up 18% year over year in April. So that's pushed the headline number up to its highest level since mid 2023. So undoing a lot of the improvement on inflation that we've seen in recent years. Core inflation remains somewhat more modest at 2.8%, although that also represents an acceleration from recent months. The chart on the right shows trailing 3-month CPI, just to emphasize how dramatic this spike has been over the last 3 months. As this shows, the headline all item CPI figures up 7.3% on an annualized basis over the last 3 months. So that's peaking higher than inflation reached at its height of 7% in 2021. So just to emphasize how sharp this price increase has been in recent months. Core inflation, again, more modest because most of this spike has been driven by energy prices, but even core inflation is up 3.2% on an annualized basis over the last 3 months. It remains to be seen how persistent this is. If the conflict in Iran is able to wind down and oil shipments are able to resume, most economists expect that the inflation numbers will come down fairly quickly after energy prices normalize. Turning to wage growth in the economy, wage growth also accelerated about 20 basis points month over month to 3.6% in April. Although with the faster run-up in CPI inflation, wage growth fell below CPI for the first time in 3 years. So that puts an end to a 3-year stretch of real wage increases, and we saw modest wage losses on an inflation-adjusted basis in April. That was fairly consistent across most major sectors, employment sectors, although there were a handful of sectors that did continue to outperform inflation, most notably information, which saw a 5.4% increase in wages year over year. Manufacturing and construction also registering some real wage growth. But on the other end of the spectrum, education and health services, which is a very large sector of the job market, saw just 2.5% wage growth, so fairly meaningfully under the all item CPI index. And again, total employment lagged inflation by about 20 basis points. Increase in inflation has also put upward pressure on interest rates in the US. So the 10-year US Treasury rate increased from about 4.3% in mid-April to 4.6% in mid-May. And that holds across most of the yield curve from midterm yields through longer term maturities. Interest rates have gone up fairly meaningfully. That's shown in the difference between this light blue bar and the dark blue dotted line here. I'm showing that difference in month over month yield adjustments. However, amid the headlines of rising interest rates, another important development that hasn't gotten as much attention is the fact that the US yield curve has actually normalized over the last couple of months. Now, that follows a period of several years of persistent inversion. So even in May of last year, as this gold line shows, short-term rates were higher than midterm rates and even higher than some longer-term rates. That has since corrected, as the line from this last week, the May 15th yield curve shows. Short-term rates are lower again, and long-term rates are higher, as would be expected in a normal yield curve setting. So the combined effect of elevated inflation and higher interest rates has predictably been a decrease in consumer sentiment. So the University of Michigan Consumer Sentiment Survey fell to a new low it's hit a couple new record lows over the last few years, and it's sunk to another record low in its preliminary May reading at 48.2, significantly lower than the 84 point reading that's been the average since 1990. Consumers remain worried, particularly about elevated gasoline prices, since that has such a visual and immediate effect on household incomes. So again, this remains to be seen if this is persistent or if it ends up being a blip in the longer term time series, if the war is able to come to a resolution, which would then bring down inflation and allow interest rates to normalize. So we'll continue to track this, but at least in the near term, we do expect consumer sentiment to remain relatively negative. That concludes our May economic update. Please continue to follow along and tune in for more updates and webinars.